Well, it's been a record first quarter in terms of inflows into municipal bond funds, which is evidence of individual investor demand accelerating. About 24 billion cumulatively in the first quarter in comparison to just 5 billion in inflows last year. And interestingly, that's sort of accelerating through tax time when flows will have traditionally become a little bit weaker.
So explain that for us, John. Why SALT in particular would be a motivation for investors to get into munis?
Yeah, I think it's a combination of factors. First of all, of course, the rate environment has become more benign, and I think behind the scenes in 2018, municipal bond investors were building up cash, sort of waiting for a then hawkish Federal Reserve policy to sort of run its course. Now that the messaging from the Federal Reserve and from the fundamental data has become much more benign and rates have edged lower, Fed has stepped to the sidelines, that's part of it. But in addition, the tax cut, at least on the top bracket, was relatively minor, from 39.6 to 37%, when you then take into consideration the state and local tax cap, deduction cap of $10,000. That actually puts a lot of municipal bond investors into what potentially could be a higher effective tax rate as opposed to a lower effective tax rate, and that makes municipal taxable equivalent yields look favorable. So it's probably enhancing demand in here.
John, so clearly there's tax benefits to owning these, but are there risks as well? What's the spread at the moment over the equivalent treasury, and how does that relate to history?
Sure. Well, first of all, if you take very, very high quality municipals, strong AA and AAA paper, those will trade in a relationship to U.S. Treasuries, and they started the year 2019 at somewhere in the neighborhood of fair value to a little bit cheap. And throughout the first quarter, municipals have outperformed. So in 10 years and shorter, munis are trading relatively richer than U.S. Treasuries, even though on the long end is still fair value to a little bit cheap. Then for bonds with more credit risk, BBB rated bonds, non-rated bonds, BB rated bonds, you're picking up on average approximately 215 to 220 basis points of additional yield for investing in high yield with more credit risk. And that's well within historical norms, and I think is fairly attractive as long as the economy continues to be on solid footing.